Right. Welcome, everyone. Hope everyone's having a good morning and a good start to the week. I hope I've been joined today by Saftar Sarwar, our Chief Investment Officer. I hope you've all been enjoying the World Cup and hoping that England will hopefully make it to the first final of my lifetime. Maybe some others maybe experienced in '66 and got close in previous years, but never have I experienced such joy from a nation. Safta being Scottish, I don't think as pleased as some others, but I think definitely rooting for England to beat Argentina on Wednesday, and maybe an interesting result this evening as well, Spain versus France. But enough football chat. I reckon everyone's probably experienced enough of that, starting every meeting with a bit of football banter. Through all client calls and certainly from us, definitely. But no, it's been a wonderful start to the year. We're already halfway through, which is absolutely crazy for all of us, and how busy it's been. I'm just missing a few more others joining us at the moment, but again, I really appreciate everyone's time. Taking an hour to listen to us talk about markets, and certainly what Binary Capital have been up to for the past 6 months. It's been very hectic, lots going on, from events to hiring, and we've just rebranded, and we've gone live with a new website, which to me it looks amazing, but I'm biased, I suppose. And then moving into the second half of the year, we have a big event next week. We've partnered with Fundment, which I'm super excited for, in London. We've got speakers from Octopus, Invesco, BlackRock, and from ourselves as well. So lots of different things going on. I'll touch on it towards the end of the today's webinar. Purely today, we're going to be focusing on, as you can probably see from the screen, well, hopefully is market outlook and portfolio positioning. And we've been quite fortunate from this half of the year. I think markets have been very tough. Lots of geopolitical shifting. From the UAE, from the US, from new prime ministers, well, hopefully starting next week, lots of different talking points. And I think the focus for us and for Binary Capital, and I'm sure Safta can agree, is just really ignoring a lot of the noise and sticking with what we always like to call our best ideas, and having that long-term thinking. And that's always been the philosophy of Binary Capital. I'll allow him to take you into a little bit more detail in just a moment. I just want to let everyone know that there is a Q&A option today. So we'll allow 15 minutes towards the end for everyone to ask a few questions. It'd be really great if you could really grill Saftar. I'm sure he loves the pressure of answering your questions, and for us and for me, certainly, there is a lot to talk about, and I could probably ask Safta to talk for 2, 3, 4 hours, and I'm sure he would love to do that. But we do have around about 45 minutes today, and then a 15-minute Q&A towards the end. And just to note, there are CPD certificates available for today. So if you do want to reach out to myself or anyone from the team and collect those towards the end, I'll be happy to pass those over. So without further ado, I will look to move quite quickly into this, because I don't want to waste too much time. And as I said at the start, and for those that may have missed it, we have just completed actually our first rebalance of the first half of this year. What changes we've made will allow Safta to answer those. We do like to, as some of you may or may not know, we rebalance twice a year at the start, and then around this time usually, and any ad hoc rebalances, we obviously make clients aware of that. But we're happy to announce that's finally gone through. So it's pleasing knowing that we work with such amazing clients, and being able to shift them back to original weightings, and give them our view on what we think the next half of the year will be. So that will be the focus, is where do we see the next 6 months going, any potential changes we're looking towards the end of the year, and certainly our view on geopolitics, and the markets in general, and then anything on the MPS. And then lastly, there are a few sort of MPS range and model changes that I'm quite happy to announce, as some of you may have seen in Citywire, which we had a great article written about us on our new evidence-based models being announced to the wider IFA market across, and more importantly to the international space now, so available in sterling and USD on the Morningstar international platform and Novia Global. And then as we progress through the year, they'll be available on many different platforms, and it just gives access to advisors not only in the UK but from other areas. And there'll be lots more details to follow, as well as new brochures, new marketing material, and I'm pretty sure more webinars like these and in person. So yeah. Without further ado, I will like to pass it on to Saftar. And like I said, Q&A, really do hit that home, ask as many questions as possible, and we'll try answer as many as we can towards the end. But Saftar, I will pass it over to you if that's okay. If you want to begin, just give me a nudge on the slides as we go.
Yeah, I'll do that. Thanks, Sam, for that introduction. And yeah, good morning, everyone. Today I'm speaking from Edinburgh, a kind of overcast Edinburgh. Hopefully the weather wherever you guys are, whether it's in England, Southeast, wherever, it is a bit better this morning. As Sam said, what I'm going to do this morning, probably for the next kind of 30 minutes, is cover a little bit about what's going on in the first half of this year. It's been a really interesting kind of 6 months, but more importantly, cover more so what we feel will happen for the rest of this year and into 2027 as well, and how we're positioning for that, how we're looking clearly at performance to deliver world-class performance that we're always trying to do at all times as well. So really kind of covering historic going forward and how we can get that top quartile, top decile numbers that we're consistently trying to achieve for our clients overall. Happy to take questions as I'm going along over the next kind of 30 minutes. So feel free to put in the chat box or whatever, any questions that then Sam can jump in and ask me. And or there'll be some time at the end for some questions as well. I know it's very uncertain times, a lot going on politically. Even the last few days, we've seen the resumption of the Gulf conflict potentially, and so on as well. Happy to answer them, address them, and at the same time look at some of the market stuff as well that clearly we pay attention to every day. So that being said, Sam, if you want to kind of jump on to the kind of first slide for this slide. So yeah, a kind of summary of I guess this year so far, year to date. What's interesting here is a couple of things. Firstly, we've got really one negative return this year in the first 6 months, which has been gold. So far negative. That being said, had a very good return clearly for the last couple of years. So there's been a bit of a pullback, which is interesting in itself because we've had a bit of we've had a lot of volatility, a lot of uncertainty. Certainly Jan, Feb, March of this year, certainly mid-Feb onwards when the Gulf War or Gulf conflict started, and gold hasn't really been a kind of safe harbor where people assumed it would be. So we don't have Bitcoin in here or any cryptocurrencies, but that would be similar. There's been a bit of a drawdown in some of those assets as well, and not being a diversifier, not being an area of safety for those assets whatsoever, which is interesting. Second point is worth noting here is we've had a pretty strong return and rally in global equities, more broadly speaking, but more specifically in two key areas, global value and global momentum as well. So clearly momentum as a factor has progressed well this year, and also value away from growth equities or core equities has done well this year as well. And that kind of touches into some of the rotations that we've seen in markets somewhat against some of the kind of tech plays. That being said as well, NASDAQ has done really well this year. Certainly, I think April and May was one of the strongest months in NASDAQ in a long time. I think most of that return happened during those 2 months, and most of those returns overall happened in those periods as well. And another thing that's worth noting in this chart is the kind of light blue at the bottom, where you've got really fixed income, not really delivering much at all, 1%, 2% in fixed income this year to date. So not a lot. And that again goes into the point around inflation being higher and rising, certainly as we had the Gulf conflict at the start of this year. And at the same time, the kind of whole interest rate cycle potentially moving from falling interest rates to potentially flat and or rising interest rates as well. And we don't typically like bonds as an investment house, and I'll go into that in subsequent slides. But something to note as well that interest rates are more challenging, and that's kind of fed into fixed income not being a really good return asset class this year whatsoever as well. The key place to be has been in equities, global equities, value equities, momentum. US has done well. UK, surprisingly, despite being strong value led, good valuations levels in the UK, hasn't really returned significant returns at all, below 10% or so. So that's interesting as a kind of snapshot around returns this year so far, first half of this year. So Sam, next slide. Something to again bear in mind that there's a lot of narrative around this in the investment space, that we've had really strong returns in many markets this year, and I'm going to touch on them in subsequent slides. Korea's done really well. We've had a bit of a pushback, pullback in Korea in somewhat in June and even earlier on this week as well, this month. The Kospi, the Korean index, is now often seen as a kind of momentum factor for what's going to happen in the rest of the kind of tech sector, because it's got so many large tech companies, Samsung, SK Hynix, Taiwan, very similar, SSMC being a large DRAM semiconductor manufacturer, and it just kind of dominates that index. But what's interesting in this chart overall is the fact that those returns, for example, Korea's still up plus 50% this year, despite the pullback. Taiwan, very strong returns this year as well. Despite those returns, and despite those significant returns this year in many of those markets, that is primarily came around from earnings and not multiples, not price earnings going up overall. So it's come from actually genuine profits, growth, market share, earnings going up significantly, which has meant share prices have gone up and returns have gone up. So it's been a more of an earnings story as opposed to what people may have thought, that multiples have expanded and therefore equities or equities in those areas are looking expensive. That's not the case whatsoever, certainly from what we can see here. For example, SK Hynix in Korea still trades at a multiple below 10 times, despite going up to 300% over the last kind of 18 months or so. So still relatively cheap based on future earnings growth. Whether you believe those future earnings is another question, but certainly it seems to be fairly robust there. So again, something to bear in mind that we've had an earnings story in many of these kind of growth markets, or many of those kind of trends that we've seen in the previous slide in terms of returns as well. And a lot of that, as I said, has come from Korea, emerging markets, semiconductors, and so on as well. And I'll touch on why that's the case in future slides. So if you go on to the next slide, Sam. So this is really interesting, and I want to kind of pause. We've got a lot of slides to go through, but I want to kind of pause and really cover this slide in a bit of detail, because I think this slide doesn't really reach not only to what's gone on and what could go on for the next 5 to 10 years. So I think it's very important to kind of pause here and kind of really touch on this slide. So we should all know about Anthropic, the global software company, private LMM, agentic AI, competing with OpenAI and so on. And what's happened this year, which is really interesting and which has been a really pivot, is firstly, Anthropic has released many of its models, one more recently, Fable, but over the past 6 months released many of its models, which have been significantly taken up by the industry, by markets, especially corporates. I'm sure many of you guys on the call have got examples of whether you've been using Anthropic, using Claude in many of its functions and so on. And what we've seen in that chart, you can probably see the dashed line, has seen significant recurring annualized revenue growth from Anthropic, and people are talking about numbers of about 50 billion a year plus revenue growth this year annualized. So very significant market share that it's kind of taken. And what's interesting is it's taking that from the software companies. So many software companies, once Anthropic, which is private by the way, announced its model, announced its new version of a model or a agent and so on. Software companies sold off, where that's some Oracle companies, some data companies and security companies as well. Many of the software companies sold off, and we feel this is interesting in the sense of what could be going on going forward. Anthropic is still private. As from a valuation level, it started the year at circa 350 billion private valuation. Now it's kind of hitting a trillion private valuation. Still yet to go public. It's authorized some data and some process to do that, and we suspect they'll probably go public in Q1 or Q2 next year. So growing very significantly, and a key disruptor to what's going on in technology overall, whether you believe in this kind of whole AI theme and story. And this chart is kind of highlighting that why is Anthropic loss making, only been running for about 2 years now, really, from the start. Why is valued at $1 trillion? Okay, it's got that strong recurring revenue stream, but the key point here is not really that. The key point here is you've got that software target of 650 billion that is at risk from Anthropic's opportunity set. But more greater than that, you've got that global label market opportunity at the top of that chart, where you've got $15 trillion potentially, if not more, of opportunity, where Anthropic and maybe others, OpenAI clearly a leading agentic AI tool as well that's out there, ChatGPT, could take that market share. So 15 trillion of labor, and that's labor everywhere, Western developed markets. As I said, we've all got anecdotal evidence of using some of these tools where we've maybe not hired somebody, or maybe not replaced someone that you had in your firm, or you've managed to do tasks that maybe took you 1 day, half a day, a few hours in 15, 20 minutes at a very, very professional level, albeit there may well be some mistakes or something that you need to check over, but certainly that task management, whether that's in Excel, Word, or other data points that one is using, has been done very efficiently. And we feel, and I feel, that is only going to increase exponentially, and that's not going to go away. That agentic AI, that AI engine of growth through Anthropic, through OpenAI, is only going to increase. And right now, to give you some context to this, right now, NVIDIA is valued at 5 trillion. It's plausible, and maybe even probable that Anthropic could end up becoming the biggest company in the world in the next 2 to 3 years. It's something to bear in mind from market perspective, as well as even exposure to this. And we're quite lucky through some of the investment trusts that we own. We've got some indirect exposure to Anthropic through those vehicles as well, and getting some of this growth around that. I'm not saying it's going to be the key winner, but it seems to be one of the signs of a kind of winning mentality and winning focus around this kind of whole kind of land grab, and certainly software around that. So I just want to kind of pause here and kind of touch on this slide, because I think it's a very, very important slide going forward around that. Similar narrative here as well, where we're seeing certainly private markets as well as public markets in terms of AI and AI opportunities. This has come from a private equity house that we follow quite closely. Again, making the kind of same kind of point that it's not, AI is not just targeting software. It's not targeting what you could do through Excel or Oracle or cybersecurity and so on. It's actually targeting labor, and that's very important. Whether it's white collar labor, blue collar labor, it's targeting all of that. So some of the stories that one hears around, or the fears around job losses and restructuring, and even graduate level jobs now becoming more difficult to come by, and significant unemployment in the youth and the graduate space seems to be more relevant going forward potentially as well, as a result of this and it's something that just to bear in mind and something to kind of manage from certainly from an investment perspective. And I'll touch on how to best to do so going forward. Next slide, Sam. Again, I've touched on this. We've had very similar alignment between software and hardware over the last kind of few years. Over the last kind of decade or so, they've been running in tandem in terms of growth. You know, we've got the Mag 7, we've seen obviously Microsoft, Netflix and others growing very strongly. But at the start of this year, the market suddenly realized that software, I've just kind of touched on it in the last kind of 2 slides, could be killed by some of these agentic AI engines, LMMs that are out there just now and revisiting and growing significantly. The reason they're staying private is because they can get capital from the markets very efficiently without having to tap into the public markets. Anthropic had a fundraise, I think it was in early April. I think it raised about 20 billion or something. It did that very, very efficiently, very quickly, without too much fuss, and similarly to others as well. Hence the reason that those software companies have been sold off or remained flat or down. And it's been the story has been hardware. That AI infrastructure layer, it's all been about hardware. Where can you invest in hardware? Hence the reason we've had NVIDIA continue to do well. We've had TSMC. We've had ASML in Holland that does a lot of the manufacturing machines for some of these semiconductor layers as well. I've already touched on SK Hynix, Samsung as well, a massive player there and one of the most profitable companies in the world. So it's all been a really kind of semiconductor story, albeit it's come off somewhat over the last few weeks. So certainly if you're investing in tech software, that wasn't the trade to be, certainly this year. It's all about tech, semiconductors, and there's very, very few funds that pivoted or exposed well into this. And one area clearly that's benefited, and I'm sure we'll touch on it at the end, has been indexation. Clearly, if you've got an index strategy, you've managed to capture this somehow through pure index, owning the index players, whether it's an EM index and or US index as well. But certainly active funds have been really struggling in this space to do so. But certainly this pivot happened at the start of this year. It's continued. There's been a bit of a sell-off. Whether this goes forward, going forward, I suspect it probably will, albeit there'll be a lot more volatility. It's just something to note and something to kind of bear in mind as you're also articulating performance portfolios to clients as well all the time. Next slide. So again, the really question of our time, isn't it? Really, are we in a bubble? Are we not? The markets are telling us, certainly from a US CAPE, cyclically adjusted price earnings ratio, the US market is very close to its levels that it reached at the dot-com bubble time, 1999 to 2000, 2001, and so on levels. I was lucky enough, old enough to kind of be there and manage through that. And I think there's a couple of things to bear in mind, and they kind of go together, and they're not mutually exclusive. Markets can be still expensive, like they are now potentially, and the next slide will not validate this point, but as they are based on a cyclically adjusted price earnings ratio. At the same time, you can still believe in this whole kind of EI thesis that EI will continue to grow, continue to develop. There'll be a lot of winners out there and growth out there, and it's generally a pivot in history that we're seeing over the last 2 years, and we'll continue to see as well. You can believe those points together, I believe. And so it's something that we kind of bear in mind around that. As I said, indexation is one way of playing it, albeit that's very concentrated now as well overall there. So if you go to the next slide, which kind of goes back to the point I made around at the dot-com bubble, we had really, really high multiples, excessively so. Companies that weren't even profitable were gaining significant price momentum. Well, even now, if you look at it from the current companies, we've got a snapshot here. They're not as expensive, far from it, than those that we saw in the dot-com bubble. You can see here, and the profit margins for many of them are very high, significant, and growing. Hence the reason they've got strong. And going back to a point earlier made about this, a lot of this has been an earnings-driven rally, not just about price earnings expansion, it's about genuine profits that are being made. So certainly it's quite different from the .com. And I think one would be quite lazy in assuming because it happened then like this will repeat itself. I don't think that's the case at all. And I think it'd be a mistake if people assumed what we're seeing now is very much a bubble, very much a .com like bubble. And therefore that bubble will burst going forward, whether it's this year, next year, or whenever. I think that thesis probably doesn't hold true. Clearly, there is excessive euphoria in different areas of the market. We've seen some of these semiconductor stocks going up. We've seen some of these AI stocks, smaller AI companies going up excessively, and some of these kind of small cap US plays, suddenly based on some obscure AI reason, tech reason going up. But that's things to avoid. But whether you want to own Nvidia, Google, Microsoft, some of these tech giants, some of the mid-cap names as well, whether you want to own US overall, because again, there's a thesis out there that could be relevant that US GDP growth could elevate on the back of this kind of productivity boom around technology. That's yet to be seen so far, but something again we are bearing in mind and noting as well. And one of the reasons that the US, despite its higher valuation overall against the UK and Europe, has done well this year so far. There was a sell-off during the Gulf conflict, but certainly Nasdaq, S&P, Dow Jones had a massive rally during April and May, and was kind of flat during July, and is a little bit down during flat during June and a little bit down during July, but nothing that we're too concerned about as long-term investors. So just to bear in mind valuations, I don't think we're in a bubble in the general context of how one defines a bubble, and therefore you shouldn't really be seeing it through that lens whatsoever there. Commodities, just touching on commodities, I can already touched on this earlier. Gold is in a bit of a sell-off after having a strong rally. Clearly, we've seen oil going up significantly at the start of this year, due to the Gulf conflict, and that then fed into higher inflation numbers and so on, higher energy costs, less profitability for some of these infrastructure and other manufacturing plays. But something that has come off now, something that we are watching going forward, clearly as the Gulf conflict may well resume as well. I noted this morning there was further tankers at issue in the Straits of Hormuz as well, and certainly people are getting more wise around Dubai, Abu Dhabi, and that region as well, and so on. So again, something to kind of bear in mind, something that we're always thinking about looking at. We're less exposed to commodities more broadly than maybe some of our peers are. And if you have some commodity exposure, we have it quite narrow, and we have it in some of our kind of best ideas portfolios that we have. We have a range now that where we pick our best ideas irrespective of the volatility and asset allocation frameworks that we have, and we have some commodity exposure there as well. And as I said, gold and even Bitcoin, BTC, has not been a level of safety this year. It's been a bit of a sell-off this year. Again, what's that telling us? Is this market telling us that we need to read more into this, or so? Is this an aberration and something short term? Who knows? But something to kind of bear in mind and note as well. Next slide, Sam. So I've touched on that. I want to touch on the outlook now for the next kind of 10 minutes or so, and then we can open up to questions. And I've kind of already talked around this somewhat. We think the best opportunities in returns have yet to come. If you're a long-term patient capital investor and willing to take that long-term 10-year view and willing to ride out volatility, whether we saw volatility in the first quarter of this year, whether you saw volatility during Feb and March last year during the whole kind of trade, tariff, wars and drama as well, whether we see volatility going forward as we see the US midterms, this Gulf conflict resuming, and or anything else going on. We think if you're happy to, and you can ride out this volatility, the best opportunities in returns, in growth equities, in equities more broadly, in the US, in emerging markets have yet to come. with those risks, just kind of caveated as well. And there'll be major themes that shape that. So if you go into the next slide, Sam. We've got inflation picking up. We've got a new Fed chair. We've got a new kind of realignment around interest rates and inflation, which has meant that there's been a bit of a sell-off in bonds. Again, something that I kind of highlighted. We've had really minimal returns in bonds, and if you include inflation, we've had nothing in bonds whatsoever. So the key place to be, I think, going forward, will continue to be equity returns. So even if you want bond-like returns or bond-like safety, the best place to get that will be in the equity markets and or liquid alternatives, which capture some equity-like returns as well there. And I don't think it'll be in the bond market. I think the bond market maybe has changed for a long time. And this kind of bond bull market that people have talked about, that we've seen over the last kind of 10, 15 years, pre-COVID, post-COVID, I think that is over now. And if you want genuine diversification, genuine return management, you need to look elsewhere, and you need to probably look more closely at equities as well going forward. Next slide, Sam. I just kind of touched on it. We've got a regime change. We've got more kind of volatility. We've got shorter economic cycles. There's a lot of momentum at play as well. So you need to kind of just manage that. Do you be patient and play that, or do you be more kind of flexible, more pragmatic? We've already seen an example of that anecdotally. You guys probably picked up on the news last week around Terry Smith and Fundsmith essentially changing one of its key metrics about long-termism and moving towards somewhat a more momentum play around that. And I think for them, that could be a challenge and potentially a big mistake to do that. And again, I'm happy to answer any questions around that. So there will be a lot more kind of being a bit more nuanced. You might see us at Buy New Capital, typically we would make one or two changes in the winter. We might make a bit more, we might be a bit more flexible, a bit more pragmatic around that. But at the same time, still having that long-term view, that long-term mindset, and not changing for the sake of any change whatsoever. And potentially, the thesis could be we may well suffer more of a drawdown, but which we have to manage, which we have to educate or articulate or communicate better to you as clients or potential clients as well around that, because that may well happen that we have a minus 20% in any one quarter or 6 months, but we hold firm to what we believe in as well around that. So we just got to be nuanced around that as well. Passive clearly has done well. Is it a movement towards more active returns going forward? Potentially, but we've been seeing that for a long time and it hasn't happened yet. The US market is relatively expensive, albeit there's pockets of returns there. We are still think that's the market still to be driving a lot of growth going forward. Next slide, Sam. So yeah, we've got to build more resilience. We've got to be more actively managed. We've got to have, certainly in our core strategies, where we have this kind of three pillar approach, we've got to be a bit more nuanced towards liquid alternatives away from fixed income. We've got to manage that performance better. I think already we've done that this year. I mean, this year our returns have been circa, on broadly speaking, plus 4% to about plus 12% up to the kind of end of June on the kind of more adventurous strategies. Those returns may not come to pass in the second half of this year at those kind of levels. There might be a bit more volatility, but I think we as a firm, and we need to just from our clients' perspective, just be kind of more firmer in the kind of volatility that may well happen going forward as well, and just understand that better and just be aware that while we've got volatility and maybe some drawdowns happening going forward, the return outlook, I think we believe is as strong as ever if you're willing to ride out that volatility, willing to communicate with your clients, willing to understand what's going on vis-a-vis software, hardware, the whole AI opportunity in the emerging markets, as well as in developed markets as well. If you go to the next slide, Sam. So we're well diversified as a firm, albeit we still have that kind of focused approach, but still diversified. We're embracing this kind of whole hardware opportunity as well. Against our the index, we're probably underweight, 48% in the US against 65% if you took 100% equity approach, our peers will be probably maybe 38 to 40 at best in the US. We're comfortable with that position. It's underway. We've not added to it. In their recent rebalancing, we kind of rebalance back to trend or back to model there somewhat, but looking more closely at what could go on for the autumn period as well, where we potentially, if we see more of a drawdown, more opportunities, we may add to some of our kind of growth positions in technology and some of the stuff I talked about, capturing some of these AI trends that we think, I feel, that 15 trillion opportunity in labour, for example, that opportunity against software, we feel if there's any funds or strategies out there that can capture those trends, we'd be happy to invest in them for that long-term view there. We continue to like EM and Asia. We think it's done well and will continue to do well, albeit there'll be pockets of volatility. We like opportunities in Taiwan and Korea around that framework, and we're happy to be there, invested there as well. And we're happy to still go into the kind of large cap, mid cap to large cap opportunities, be a bit more balanced in some of our portfolios as well. US mid cap should do well going forward there. And so we've got some positions there as well for some of our portfolios as well. As Sam articulated, we did a recent rebalancing that did well back to models as well. So steady as it goes, not changing for the sake of a change, seeing what we can see going forward. We think there's more opportunities, but we do want to embrace those opportunities just now based on the volatility that we've seen more recently, this week, last week, in June as well. We'd rather wait for better opportunities than re-enter some of these sectors or go more overweight them potentially as well. We're well positioned from a US perspective. We feel we're not significantly underweight, we're not overweight at all, or even neutral against a market cap weighted index. Happy to do that. At the same time, we are flexible to mandates, and as Sam said, we recently launched our evidence-based strategy, which is around different evidence-based factors, academic factors going forward as well. If you look at the so if you go to the next slide, Sam, next few slides. We'll cover. I've kind of covered this, kind of thinking like best investors, long term, being pragmatic as well. At the same time, we don't just invest in index and active. Often we'll do both in many of our core strategies. Try and get the best managers out there at all times, which we feel there's not that many out there that can do this really well. Hence the reason we take our time, and once we have someone, we follow them very, very closely. The point I made about Fansmith stands, people change and chop and change, and that could happy to answer questions around that about what could be happening there going forward. Next slide. I mean, again, very briefly, I think I've talked about this before. There's most returns, and this is the same now as it was last year, last 20 years, last 10 years, happens in a very few number of stocks. You can either capture that through indexation, I get the haystack, or you try and capture that through some genuine quality active managers. We try to do both. Clearly, in our index strategy, we do that as well. Overall, we capture that. And Anthropic, NVIDIA, OpenAI, Minimax in China, TSMC, DeepSeek, Meta fall into that cluster of the best companies in the world now and going forward as well. Significant land grab opportunities, and again, something that we'll try and use that academic thinking into our practical thinking day to day for market returns. Next slide, Sam. Active, passive, we'll take both if we have to. We'll combine the best philosophies. We think active management could be coming back into vogue somewhat going forward, based around the concentration in passive, based around some of these factors at play, based around this kind of pivot that we're seeing in markets and trends in terms of share price opportunities in emerging markets that requires genuine good active skill sets. But there's not that many active managers that do it really well out there. So we're conscious of that, and we'll take our time investing in them If you do invest in them, we'll invest in them with reasonable conviction. If we don't like someone, we won't invest in it. I don't know. Anecdotally, there's about 10,000 active investment houses in UK, Europe, US. We probably look at 100 at best that we think are any good, and we invest in 10. So that's how deep we'll go, and we think the rest add little or no value. You'll be better off just buying an index fund. So why would you want to invest in such a strategy or fund house anyway? So we won't do that. Next slide, Sam. Yeah, we combine the both. I kind of touched on this. We can have a kind of 3-pillar approach to investing for many of our core strategies. So it's not about fixed income, which we think will not produce returns or optimal returns going forward. It's all about the equity bucket, the equity sleeve, where we can get returns and opportunities, as well as the liquid alternatives, which we feel replaces some of the equity type returns, replaces some of the fixed income return opportunities. At the same time, it should insulate us from some of these drawdowns that I just touched on that we may well be facing going forward in the second half of this year into next year. So if you have a 10-20% drawdown, some of these liquid alternatives that we have should minimize that, even go up in value against that, because they're very much non-correlated against fixed income and equities. When you talk about Fulcrum, AQR, very interesting funds. We have 4 or 5 positions here out of potentially 100, 200 funds, choices that one can use out there overall. Yeah, so next slide, Sam. I've kind of touched on this kind of 3-pillar approach to investing and why we do that really well, we feel. This is not just a fashion or a trend we thought about this year. We've been doing this for about 5 years now, and I've been reading up about or studying and engaging around endowment investing, which has come from the US for the last 20 years. So we like to think we understand this area really well, how one can blend in equities, fixed income, low duration fixed income, which is what we like just now, as well as liquid alternatives to create well-managed, risk-adjusted portfolios for clients for that long-term 5-year, 7-year, 10-year time horizon that typically your client should be invested in for that period of time. And as I said, moving away from that kind of 60-40 model to a more kind of 30-50 20 kind of framework, very deliberately, very focused around that kind of high conviction approach to investing still. And the proof is in the numbers. The numbers have been very compelling in this strategy, as well as some of our other strategies as well. Next slide, Sam. Yeah, I mean, I won't touch on this. You guys can read this afterwards if you want access to the deck. Just kind of really covering why would we do an endowment model. You're managing the risk better. You're managing the return profile better. You're getting the best of alternatives that are out there that are increasingly interesting, whether it's quant-based strategies, whether it's private capital, whether it's different commodity-based frameworks as well. And you're actually leading from a kind of asset allocation perspective as well as from a return perspective. So not only are you getting very strong return outcomes, profiles for clients, low risk, medium risk, high risk, you're getting a very strong risk-adjusted return outcome for clients as well there. And so therefore, in that kind of return profile, why would you not want to take on or invest in a strategy that's giving you minimal drawdowns, so a much more smoother end-to-end point from left to right going forward in terms of kind of real returns for clients, and you're getting the best of everything. You're not just getting pure equities that you may well fall in a kind of volatile environment. And I think we were one of the first, one of the rarest MPS or DFMs out there that does this really, really with conviction. We've got as much as 15-20% in liquid alternatives in some of our strategies. Our peers may have 5% or so. And many of this has been validated by looking at the best models that, for example, JP Morgan have, AQR have. So we run it through their investment engines and so on. And they've kind of validated that from a risk and return perspective. This is a really interesting asset allocation framework. So if for nothing else, I would encourage people to kind of have a look at this more closely, certainly going forward. Based on what I said about more volatility, maybe a drawdown to happen. I don't know when it could happen. I have no idea. I have no timing anticipation. We tend not to want to time markets, that binary capital, because we don't think we have any intelligence or expertise around it. So why would we want to do that? But we've got to be obviously aware of it, conscious of it, and manage portfolios in anticipation of it potentially happening whenever it happens. Again, last couple of slides before I kind of wrap up. I don't want to dwell on it too much. Hopefully some of you guys are aware of this, whereas as clients and potential clients and so on. Our performance kind of stacks up. Certainly this year, last few years, last 3-4 years, we've been certainly from a peer group perspective, peer group of say circa 100 DFMs or so, we're in the kind of top 10%, something that we're very proud of in terms of our returns. And even from a risk perspective, you can see here our kind of core strategy come from a risk and reward perspective. Firstly, a couple of things to note. Firstly, that those kind of blue dots are well aligned. So they're well risk managed anyway, from low risk to adventurous kind of higher risk as well. And at the same time, they're certainly giving you very significant, good risk adjusted returns against the kind of IA sector, often better than the kind of IA sector as well. You can look at it from a 1-year perspective, or even since inception as well. It's above often, or close to, or above, or less risk than, with a similar return profile than the kind of IA sector there. So again, something that we're very kind of proud of, that we can deliver from a return perspective. Again, next slide, sir. Again, very similar, our kind of passive strategy, pure asset allocation view, market cap weighted. We've kept it very simple, very low cost against the peer group, probably the lowest cost in the UK DFM space. So, if somebody's wanting low cost, efficiently managed market cap weighted, pure asset allocation view, this is really compelling. Again, you can see from an IA sector perspective, this year has been a bit more volatile. The benchmark's been all over the place as well. Firstly, the risk management is well aligned, is well spaced out, and at the same time, again, you've got the blue dots above, often significantly above the triangles, the red triangles. So again, good risk and return management, and often that risk, risk on terms of the higher growth portfolios, it's not excessive. Often they're at the same level of risk, but certainly better return. Why is that? Good diversification, underweight the US relative to the global index, above clearly the peer group, or probably above the IE sector, and probably above the IE sector in terms of EM, and still not, despite people saying one should have so, still not having that kind of home bias to equity returns from a UK perspective as well. Not really having that, not really doing that at all. So again, I kind of hopefully covered what we've seen this year in terms of returns, what we could be seeing going forward, which is, in my view, more volatility, more risk management needs to be done better. So we could face some drawdowns. We've seen this massive land grab in terms of software to hardware. We've seen this the LMM engines, the AI engines, certainly Anthropic, less so OpenAI and ChatGPT, taking significant opportunities and revenue away from some software companies. And I think that's only the start, if you believe in this kind of 5 to 10 trillion to 15 trillion labor opportunity that's set out there. Why is it valued at $1 trillion or so? So big opportunities there. So that being said, I'm going to wrap up now. I've kind of maybe overstayed my welcome here somewhat.
No, all good, Saftar. You've been very, very useful. Thank you.
And so I'll take it back to Sam for any questions that he's got, and or you guys have got. I'm happy to address them now. Not a problem.
Great. Thank you, Saftar. No, really good. Really insightful from yourself. Certainly so much has gone on and this year, and I imagine a lot more will go on for the next half of the year. I think just to summarize a few of your points, and certainly for maybe some clients here today, in terms of the rebalance, like I said at the start, we do like to rebalance twice a year. And the reason for that is allowing, the funds that we pick, the fund managers, the investments to really run and rebalancing so frequently can really harm a portfolio or client outcomes in the long run. And that's the kind of philosophy that we've always stuck to for the last 8 years of been running money. But certainly there might be times in the future, and there are discussions around potential ad hoc rebalances that maybe come in the winter time and November, October, depending on market conditions as we move forward. But there's a few points here that I wanted to cover with you, Saftar, based on points you've raised, and maybe some questions that advisors or potential even end clients would want answered. So I think one would argue that actually markets have actually performed fairly well this year, albeit considering there's been some major sell-offs in March, for example, and April. Is there anything, or what's giving you that confidence to remain quite constructive? And what do you think of those views? What could change that opinion? Certainly in the shorter term.
I think Sam, obviously if we felt there was significant market sell-off, as I touched on, whether it's what happened during COVID, albeit there's a pullback quite quickly, or certainly what could happen during the dot-com era. There's been a lot of comparisons to that. If that we felt that was happening, and there's something more significant around that, then clearly we as a firm would take that into action. We felt this was a 1 year or 2 year, for example, pivot to de-risking and a major bubble bursting. Clearly, we would have to act in the best interest of our clients and move to lower risk, whether that's fixed income or strategies, and mitigate those drawdowns. The core strategy, we might add more alternatives in there, for example.
Yeah.
I just don't see that happening just now. I see volatility for sure. I see drawdowns for sure. I see maybe a 10-20% drawdown happening in the next 6 months, in the next 2 years. I don't know when. So I don't want to try and anticipate that or time that. we would ideally want to manage through that. Okay, because we've done that before. There's been other drawdowns. We've already had 10-15% drawdowns at the start of this year. We've had it last year. We've had it in previous years. We had it in 2022 when we had that inflation issue as well during the Ukrainian conflict starting in February of that year. And I think the most optimal thing to do is to manage through that, because you do not know. Nobody knows when that drawdown will bottom, and then you get the upside again. Just like we didn't know what would happen in April, May of this year when NASDAQ was up 20% in those 2 months, two of the biggest months it's had in 15 odd years.
Yeah, no, for sure. And I think during COVID, there was times where even fixed income wasn't that defensive asset class that usual investors for 10, 15, 20 years prior were looking to invest into. And I think that's where the 3-pillar approach, like we spoke about today, is really important. Having that access to liquid alternatives does make a massive difference in terms of diversification, and making sure portfolios are managed within those kind of risk buckets that we adhere to on a yearly basis.
Absolutely. Another thing to note, Sam, is say we have a drawdown, and I've been speaking to Amir about this a lot in the office. We may well add to some of our positions because we think the compelling nature of technology shifts and AI is so compelling that it's worth investing in for our clients, albeit in a very diversified manner. I'm not saying go 50% in tech or software, but saying in a diversified manner is really, really compelling to invest in for accounts, for sure.
And I think that, on that point, just briefly, and it'd be really interesting to hear from maybe some people today and on conversations you've had around AI and how they would react to seeing a sort of artificial intelligence fund within their portfolio. Would that cause more issues for yourselves? Do you think that would open the talks around, like we talked about today, things being overpriced or being too expensive? Would that worry a client, or would that have a slightly more positive effect? Who knows? So it'd be interesting to hear maybe after today. Saftar, we obviously have mentioned that we are underweight US equities in comparison to global indexes and maybe even some peers. What other opportunities do you, off the top of your head, I don't need to list them all, but tell me some of the other opportunities out there that you think that could replace that difference in allocation to the US?
I think certainly what we said at the start of this year, emerging markets, albeit they've not really performed as a group well. There's been pockets of growth, Korea, has done well, as well as Taiwan. Albeit that sits within Asia Pac. Asia Pacific has done really well this year. I think emerging markets are very compelling from a valuation perspective, from a return perspective, from a growth perspective, from the fact that it's the only area we've not really touched on it and on this call. It's the only area of the world that's got strong population growth. Everybody else has got longevity issues, around an aging population and clearly healthcare issues and managing welfare budgets and all on that, which manifests itself in political issues. We've got that in the UK, we've got that in the US as well. So and I think that's very compelling going forward. And I think opportunities there, and even I know historically we've had investments in China, and I think that could also be another one that we have another closer look at as well. Because again, the AI arms race is going to be won by the US and/or China or both. So one needs to be really positioned and understand that better to see how can you get exposure to tech and healthcare in China as well. Because certainly we had the DeepSeek issue a couple of years ago, and I'm sure there'll be others that pop up from there.
Absolutely. Yeah, it's always an interesting conversation, is it, around about China and having that as a part of the portfolio. We did a few years back have a direct allocation to China and sort of sold that, I think last year, wasn't it, or the year before? Okay, we've got a few minutes left. If you could just quickly speed run this one, because I bet everyone's hungry. I know I am, and ready to go for lunch in the next sort of 10-15 minutes. If there is, one sort of single message that you would want to pass out to sort of end clients or the advisors, what would be that message be in terms of the next 12 months?
I think one key message is there's going to be a lot more volatility. I think volatility is going to be more significant. That's fairly normal, isn't it? But I think it's going to be more enhanced than it has been seen over the last couple of years. We're going to have a much more, the rise of indexation, the rise of quant trading, the rise of, all these pod shops means there's more volatility anyway, and there's going to be more volatility. So one needs to be conscious of that. There may well be a drawdown or negative market returns in any 1 quarter, 6 months, even a year. Potentially, one needs to be aware of that, be cognizant of that. At the same time, therefore, whereas investing in a kind of free pillar, core, more endowment model approach is more suitable for clients to manage that risk as well as return, may well be more compelling for them, away from pure indexation or pure active management overall. At the same time, that being said, I still believe, as we sit today, Sam, mid-July, that the technology opportunity globally is very compelling. Just finding the right areas and pockets to invest in and the right entry points. And we feel that may well come in the end of this year. So don't be surprised, as you alluded to, Sam, whether we have a tech position or an AI position or something similar in that kind of mindset in some of our portfolios may pop up end of this year, early into next year, for that long-term 10-year view, for that 15 trillion labor market opportunity that I've touched on earlier.
Perfect. No, that's a really clear, concise message. I think it's important for advisors to hear that. So yes. Okay, great. Lastly, I'd like to say thank you to everyone for taking the time to listen to us speak today. I hope it was insightful for you and maybe took a few messages or key facts from the presentation. If you did want to get a copy of the deck today, please reach out to myself or the rest of the team. Equally for CPD certificates, I'll happily send those over to anyone. We do have our event happening next week on the 23rd in London. If anyone did want to attend, I really do implore you to come. It'll be a really great day out, starting around 1:30 and finishing around 4:35 p.m. With a bit of mingling and food and drinks afterwards. So it should be a good day out. We'll all be there, the whole team, and Saab will be doing a talk on the binary capital, as well as a different range of other talkers. So yes, thank you again, everyone. Come on, England, and we'll hopefully speak soon. Thanks now. Bye.